You are tuned in to The 5-Minute Signal, Business and Wealth. I am Vivian Thorne, economic strategist. This is not a finance podcast. This is a blueprint for building and defending your economic fortress. We don't do speculation here, we do strategy. 5 minutes on the clock, let's get to work. Yesterday, the Dow Jones Industrial Average shed over 800 points, a visceral reaction to the implementation of the new 15% global trade surcharges. While the headlines focused on the sea of red across the S&P 500, the real story was written in the shadows of the bond market and the gold pits. Gold surged nearly 3%, breaching the critical $5,200 resistance level, while the 10-year Treasury yield signaled a deepening skepticism regarding the long-term fiscal health of the United States. We are seeing a market that is no longer reacting to earnings, but to the sheer weight of legislative volatility. This matters because we are witnessing a fundamental decoupling. On one side, you have the political machinery touting the growth potential of the One Big Beautiful Bill Act, which aims to inject liquidity through tax withholding adjustments and 100% bonus depreciation for capital investments. On the other side, institutional smart money is looking at the $3 trillion deficit projection over the next decade and quietly exiting the room. When the largest allocators on the planet move from risk-on to neutral in a single month, it isn't a hiccup. It is a strategic repositioning. They are moving capital out of high-beta equities and into the relative safety of private credit and infrastructure assets that are insulated from the daily whims of Washington. The hard truth is that the buy-the-dip mentality is a relic of a low-volatility era that has officially ended. Conventional wisdom tells you to trust the resilience of the American consumer, but that consumer is currently being squeezed by a structural tightening of credit and the phasing out of SNAP benefits under the new fiscal regime. The reality is that we are entering a period of crowding out where massive federal debt issuance forces interest rates higher, regardless of what the Fed desires. If you are waiting for a return to the old normal, you are already a casualty. We have to think for ourselves. We must look at the data and analyze it with unbiased sentiment, unclouded by the hope that things will simply get better. Like I've said before, hope is for the unprepared. Strategy is for the survivors. Here is the actionable move for your economic fortress. First, audit your exposure to interest rate-sensitive sectors. With the 10-year yield projected to climb as debt-to-GDP ratios head toward 180%, any business model reliant on cheap, short-term debt is a liability. Shift that exposure toward firms with high free cash flow and fortress balance sheets. Second, mirror the institutional move into value. We are seeing a multi-year low in value stocks compared to growth. The smart money is moving into utilities and telecommunications because these sectors generate stable income even when the broader market is a minefield. Third, treat gold not as a trade, but as an insurance policy. As central banks continue to average nearly 600 tons of quarterly demand, the floor for gold has fundamentally shifted. Secure a position to protect your purchasing power against a currency that is becoming increasingly weaponized by fiscal policy. Stop watching the ticker and start watching the capital flows. I'm Vivian Thorne. This has been the 5-Minute Signal. Stay sharp. This program is for informational and educational purposes only. This content is not a substitute for professional financial, investment, or legal advice. always consult with a qualified professional before making any financial decisions.